Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife podcast. I am your host, Dan Sipe. Additionally, I am the branch manager here at Sipe and Associates and Serving Those Who Serve. I want to begin, as I always do, by saying thank you. Thank you for taking the time to listen. I see the numbers going up every month. It really warms my heart. But above all, thank you for your service. Thank you for the service you provide to every single person in this country, including me, including Ed, including Arik, our sound guy, my wife, my kids. We are grateful. You do not hear that enough. I am your biggest cheerleader out there, making sure everybody knows that you should be thanked for your service. And until they all do it, I'm not going to stop, and you'll always hear it here. The other thing that you always hear here is the guru, Ed Zurndorfer. He is back with us again as part of our ongoing mission to reach, teach, and serve you. I need to begin at the outset, as I always do, to say that the opinions of our guest, Ed Zurndorfer, even though they are awesome, are not the opinions of Raymond James of Serving Those Who Serve. This podcast is presented for information only and not intended to be taken as advice. All listeners consult their personal advisors before taking any action, and if you do not have a personal advisor, hit us up at stwserve.com. We will help you any way we can. And once again, we follow Ed's FedZone articles at fed-zone.com. Head on over there, check them out, especially this group, because we've got an awful lot of tables involved. But one more way that we can reach and teach. This episode, we will be on tax topics. The first is that the IRS has updated life expectancy tables. Big deal, you say. Actually, it is. Ed's going to explain why. And we'll finish up with how our feds who over-contributed to IRAs in 2021 can correct that. That may not apply to you, but let me tell you, if it does, you're going to be happy that this exists. We're really proud of the fact that we make sure that information that could matter is out there. Maybe every single Fed needs it. Maybe 100 Feds need it. Maybe 10,000 Feds need it. We're going to put it out there. It's going to be searchable. It's going to be findable on our website. But I want to stress that every person listening to this should go to fed-zone.com because there are a ton of tables to help you understand. So, Ed, the new life expectancy tables. I have to admit, I was a bit surprised. Even with the COVID pandemic, life expectancy increased?
That is correct, Dan, but I have to point out that the IRS for years was talking about updating their life expectancy tables as a result of people living longer. Life expectancy actually had gone up. Now, this is pre-COVID. The IRS actually had completed the implementation of new life expectancy tables back in November 2019. And this is pre-COVID. That being said, the question being, well, how did the COVID affect the fact that so many people died from COVID? How did that affect the life expectancy tables? And the answer is it didn't. For the simple reason there's no data out there as a result of people dying, so many people dying for COVID. There's no data out there how it's going to affect life expectancy. We don't know yet. If someone, let's say, came down with COVID and they hopefully recuperated, how that's going to affect their life expectancy, we don't know yet. So therefore, at this point, there's not going to be no changes. Now, maybe IRS will update their life expectancy tables maybe 10 years from now. But they were delaying implementation of the new life expectancy tables. At first, originally, it was supposed to be 2021. January 1st, 2021, but because of all the problems with the COVID as far as IRS was concerned, and we know there were several problems associated with the tax filing and other related things to COVID, they delayed it to 1 year. The new tables took effect as of January 1st, 2022.
Yeah, it makes sense. Now, these changes will impact most folks primarily in the area of required minimum distributions from IRA, TSP, 401ks, correct?
That is correct, Dan.
And a longer life expectancy means lower required payments, right?
That is correct. Now, that's the good news. That is the good news. That because the life expectancy factors that are used to compute the required minimum distribution, and let me just review here for a moment how the required minimum distributions are calculated. If an individual has reached his or her required beginning age, for most people, this is going to be age 72. There are still some people out there who reach their required beginning age at age 70 and a half. That was for people born before July 1st, 1949. Before July 1st.
Gotcha.
Anybody born after June 30th, 1949 has a beginning age of 72. For example, I was born in January 1951. So my first RMD is due no later than April 1st following the year I turn 72, which will be in 2023. So I have a little longer to wait until I have to take my first RMD. And so it is based on one's account balance as of, if one needs to take an RMD, the way IRS computes the RMD is based on your account balance as of December 31st of the previous year, whether it's the account balance for the TSP or a traditional IRA or a traditional 401k. Look at your account balance and divide it by what's called a life expectancy factor. The bigger the account balance, as of December 31st, the more is going to be your RMD. The smaller the life expectancy factor, the larger is going to be your RMD. If the life expectancy factor is larger, your RMD will be smaller. That's the good news. And people say, what's the big deal? The big deal is when you're talking about an RMD for the traditional TSP, the larger the RMD, the more is due in federal and state income taxes.
Oh, yeah.
So this is good news.
So let's dig in. You talk about three tables. Walk us through what they mean and how they're used. So first up is the Uniform Lifetime Table. How is that used?
The Uniform Lifetime Table, Dan, is used to calculate lifetime required minimum distribution, RMDs, from an individual's traditional IRA. If you are a traditional IRA owner, not a Roth IRA owners do not have to take RMDs if you're an owner of a Roth IRA. But if you're the owner of a traditional IRA, you have to take an RMD from the traditional IRA each year. If you also own, or you are an owner of an individual a qualified retirement plan account, that includes the TSP, you have to take an RMD from every qualified retirement account that you own. It could be a 401k, it could be a traditional TSP, it could be a 403B plan. You have to take a separate RMD from each of these type of accounts. Each one there's a separate RMD. And the Uniform Lifetime Table is used to calculate the RMD from each of these accounts.
Okay, got that. So up next, you have the Joint and Survivor Table, Joint and Last Survivor Table. How is that one used?
Okay, this table is used when the spouse is the sole IRA beneficiary or the qualified retirement account owner, and that includes the TSP, and the spouse is more than 10 years younger than the traditional IRA owner or the qualified retirement plan owner. There's at least 10 years age difference between the two. And the reason that's important is because there's such a large age difference between the two, there's going to be a larger life expectancy, meaning that the RMD is going to be less. So you want to use the Joint and Life Survivor Life Expectancy Table as opposed to the Uniform Table, in which it is assumed that if the spouse is the beneficiary of the account, then there is less than a 10-year age difference between the spouse and the traditional IRA owner or the qualified retirement plan owner. For example, my TSP account, my wife is my beneficiary, and there is about a 4-year age difference between the two of us. So I would use the uniform lifetime table when I start taking out money out of my TSP for the TSP RMDs.
Gotcha. So last up is the single life expectancy table. When would somebody run into using that?
Okay. This single life expectancy table is used by either of the following two individuals. It could be used by a surviving spouse who is the sole beneficiary of a deceased spouse's IRA. I have a traditional IRA. My wife is the beneficiary of my IRA. Okay? So if I pass away and she inherits the balance of my IRA, she would use that table to take the money out of the IRA, because she would be required to start taking money out starting the year after I pass away. She would use this single life expectancy table. Gotcha. Another individual who would be eligible to use a single life expectancy table, I should say who has to, is somebody called an eligible designated beneficiary of the individual's IRA who inherits the traditional or Roth IRA owner's account at the time of his or her death. Now, who is an eligible designated beneficiary? It's someone who is disabled, who is chronically ill, who is not more than 10 years younger than the IRA owner, or a child of the IRA owner who has not reached the age of majority. I want to point out that with these three different tables, I have a portion of the tables in that column, the column came out on January the 12th in the Fed zone, and I have samples, a portion of the table. I don't have the entire table because you're talking about huge tables, so I have a portion of it. And what I did, Dan, was I have the new updated tables that took effect January 1st, and I compared them to the old tables that were in effect through December 31st, 2021. And you can see side by side what the differences are. The life expectancy factors generally went up. They increased for everyone.
Yep. And I was just about to say, folks, head over to the Fed Zone. That's fed-zone.com. You can also get there through the Serving Those Who Serve website, stwserve.com. Tons of tables, tons of great information. It's really going to help you understand this. And again, we realize that not every Fed is going to need this right now. But there's 2.2 million Feds out there. And that's not counting retirees. So we want to make sure that we are constantly generating the information that's going to help people, regardless of whether it's the majority, the minority, or what have you. And this is great stuff. And quite frankly, I don't know of any other place doing it. So we're here. Pass it along. So,
Dan, I just want to mention
Sure.
that when people are saying, "Oh, he's talking about RMDs," I'm not. This is for people who are retired, who are over 70 and a half. Keep in mind that if you are a federal employee and you inherited an IRA from a deceased parent or a sibling, you are subject to RMDs under the Secure Act, that took effect on January 1st, 2021. If you are a beneficiary of a deceased relative's IRA, no matter what your age is, you have to take money out of that IRA. You got a certain deadline to get the money withdrawn from the IRA. Now it's 10 years. But if you are what's called that eligible designated beneficiary,
Sure.
Then you can take the money out over your life expectancy.
That's
what
important.
I'm really saying, Dan, is that you don't have to be old and gray to have to be taking out RMD. You could be young. One other thing I want to mention, that those federal employees who inherited IRAs from deceased relatives before January 1st, 2020, the relatives died before that, you're under the old rule which allows you to take the money out of that inherited IRA over your life expectancy. You don't have to take it out within 10 years. And the new single life expectancy tables reflect the show higher life expectancy factors, meaning you have to take out a little less. I urge everyone to read this, to get a hold of this column. Again, it's dated January the 12th, 2022 in the Fed Zone. It talks about IRS updates the life expectancy tables, and I have examples in there. This is not easy stuff, Dan. I really took the pains. I really took the pain to be to do everything exactly, make the examples as readable and understandable as possible, particularly when it comes to these inherited IRAs. It's very important you read the examples to get in order to have a full understanding of the consequences of these new life expectancy tables.
Couldn't agree with you more, brother. That's why I ship everybody over to the Fed Zone to read that stuff. Now, Ed, you and I both hate the idea that any of our feds could end up having a snag with their taxes, but if there is a problem, it's good to know there might be a solution as well. So today we're talking about when one of our feds might have put too much into an IRA, running into an excessive contribution penalty. So tell us what that penalty is and how someone might run into it.
All right. Okay.
Ooh, that was a sigh.
let's start off here with the contribution limits to an IRA for the year 2021, because it's not too late to contribute to an IRA for 2021. As we had talked about in a previous podcast, you have until April 18, 2022 to make your 2021 IRA contribution. The contribution limit for 2021 is, if you're under age 50 as of December 31st, 2021, you can contribute a maximum $6,000 to an IRA. Now, when I say an IRA, it can be a traditional IRA, it could be a Roth IRA, it could be a combination of both, but your total contribution cannot exceed $6,000. If you're over age 49 as of December 31st, 2021, you can contribute a maximum $7,000 to a combination of IRAs. That's the limit. Now, suppose somebody blew the numbers. Over the past year, during 2021, a person, let's say, was under age 50 as of the last day as of December 31st, 2021. And they did not realize that the limit for somebody under age 50, limit for contributing to an IRA, was $6,000. They thought they could put $7,000 in. $7,000 into the IRA. That's only for somebody who's over 50 as of the last day of the year. So here it is January 2022. They get a statement from the IRA custodian that they put $7,000 into the IRA, and they're very satisfied. Guess what, Dan? They over-contributed to their IRA.
Yep.
They have until April 15th to back out that excess $1,000. And what happens if they don't? IRS will impose what's called an excess contribution penalty. And what is that penalty? It's 6% of the amount of the excess.
Ouch.
6% of the amount of the excess. So, in this case here, what is 6% of $1,000? $60. They owe a $60 penalty.
Yep.
If they don't back out that $1,000 by April 18th, then IRS will impose that $60 penalty, and they better back it out, because if they don't do it by December 31st, 2022, they're going to be subject to another 6% penalty, as well as interest charges in 2023. So it's very important that they back out that $60 contribution. I got to share a story with you about. I got to share a story with you about this, Dan, because I had an incident in my tax practice a couple years ago, when the stock market was really booming, like it did in 2020, 2021. I had an individual. I did his taxes, and he overfunded his IRA. He had his money invested in a good stock fund. He really got a good return that year on the contribution. He noticed that the return in his IRA, the fund he invested, he got about a 22% return. And he's so happy. He's so happy that he got that 22% return. And then he wanted to share with me his statement he got from his IRA custodian. And I noticed that he's under age 50. In that year, the maximum contribution one could make was $5,500, not $6,000. So and there was a $1,000 catch-up contribution. So he actually put in $6,500 rather than the maximum $5,500. And I said to him, guess what? You have to back out that extra $1,000. You have to back it out. And he said to me, well, what happens if I don't? I said, you're going to be subject to a $60 penalty, 6% of $1,000. He said, I'm not so sure I want to back it out. I said, what are you talking about? What do you mean you don't want to back it out? The way he figured it is that because he got a 22% return on the money he contributed to the IRA for the year, the full $6,500, that he'd rather pay the penalty of 6% knowing he got 22% of the money. He's still going to come out ahead 16%. I said to him, sir, it doesn't work that way with me. As a certified accountant, a licensed accountant, I have to tell you, either you back out that $1,000 by April 15th, or I'm not going to prepare your taxes. I cannot allow that to happen. Gotcha. I mean, this is some of what I call creative thinking here that is not going to work. Anybody who is licensed to the hilt, accountant, has a professional obligation to tell the person, sure, you have to you have to back out the $1,000. So this is very important that people do not overfund their IRAs. They're very careful. And the good news is you still have time. You have until April 18th to back out the excess contributions, and you won't be subject to a penalty. And in the column, I talk about how you actually back out the money. You can back out the money. Another problem that occurs sometimes when it comes to overfunding an IRA is the following. There are rules as far as who can contribute to a Roth IRA in terms of income. If your adjusted gross income is too high, then you're not allowed to contribute to a Roth IRA. You're always allowed to contribute to what's called a non-deductible traditional IRA. Non-deductible means your contribution is not deductible. You put the money in, it will grow. The earnings you get will grow tax deferred. And when you pull money out of a non-deductible traditional IRA, you're only going to be taxed on the earnings, therefore. There's Gotcha. No income or age limitations for contributing to a non-deductible IRA, but there is income limitations for contributing to a Roth IRA. If someone during 2021 funded their Roth IRA, and now in January they discover that they weren't eligible to contribute to Roth IRA, and they don't back out those Roth IRA contributions. And how would they back it out? They do something called recharacterization. They recharacterize the nature of the IRA. Recharacterization in this case means instead of being a Roth IRA, it's going to be a non-deductible traditional IRA. And there are no tax consequences in this case for recharacterizing the Roth IRA to a non-deductible traditional IRA.
Gotcha.
If they do not recharacterize, they just leave it in the Roth IRA, that is also considered to be an overfunding of an IRA that is subject to a 6% excess contribution penalty, Dan.
Gotcha. And that is in perpetuity, right?
That is every year you're going to be subject to that 6% penalty.
Yep.
Why would somebody want to pay that?
Nope,
why would somebody want to pay that penalty? Don't get me wrong here. We all have to pay our fair share of taxes.
Sure.
But to me, when you pay a penalty, it's wasted money, when in fact you could correct it and not have to pay that penalty.
Absolutely. Absolutely. Brother, that's valuable information as always. And folks, I don't know any other place or any other person bringing this to you. That's just who Ed is and who we strive to be. If it helps one person, we want to make sure there's a place to find it. We are here to serve. It's in our name, serving those who serve. So that's why we do these things. And if this doesn't apply to you, that's fine. No hard feelings. You can tune in and tune out. But just remember that it's there, because one of your friends may mention it and say, hey, wait a minute, I know where you can find some information on that. Brother, we appreciate what you do, especially what you do for all the feds out there, and what you help our team with learning to serve them even better each and every year. Folks, that is a wrap. We are serving those who serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. Share it with your friends and strangers. Check us out on Twitter and LinkedIn. And do not forget our live webinars every single week. Just go to STWS website, stwserve.com. You'll see the big red or blue button, actually. It's changed to blue. On the landing page, click that. You will see the menu. The guru comes to you, reach you where you are, teach you where you are, and serve you where you are. That's what we're all about. Sign up for one, sign up for all of them. Share it with your friends, share it with your neighbors, share it with your enemies. They will thank you. Be sure to read every week in the Fed Zone at fed-zone.com. And so, for Ed, the crew at Serving the Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one, because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.